Thank you very much for the kind words you have said. I'm indeed very happy to react with you all after a lapse of 50 years. 50 years is a long period, and I do know that all of you have done well during this period and have accomplished much and occupied important positions in life. Some of you may have retired, or many of you may have retired, but I'm sure that you lead an active life. Let me greet you all on this day and convey my best wishes for a long, healthy, and active life. The 50 years, India has changed a lot. If you look at it purely in economic terms, the per capita income of India has increased tenfold, looking at it in constant prices. This is so despite the fact that the population has been increasing. We have done well in terms of the growth in the recent period. I shall come back to it a little later. Life expectancy is nearly 1.5 times what it was in 1970. In 1970, India's exports and imports taken together was only about 7% of GDP. Today, India's exports and imports of goods constitute nearly 49% of the GDP. Therefore, in many directions, changes have happened. And perhaps I should also mention that while the poverty ratio in this country has come down quite substantially, it was somewhere around 50% in 1970. It has come down to almost about 25 to 26% now. And nevertheless, if you look at it in terms of the Human Development Index, which the United Nations puts out, India still ranks in the bottom 1/3 of the League of Nations. Therefore, there's a long way to go and to do things. But if you look at the performance of the Indian economy over the last 50 years and more, one thing stands out. 1991 is an important landmark in the post-independence economic history. Acute economic crisis triggered by a severe balance of payments problem. But the crisis was converted into an opportunity to bring about fundamental changes in India's economic policy. There is a common thread running through all the measures taken since 1991. And that is to improve the productivity and efficiency of the system by injecting a greater element of competition. This is sought to be achieved by removing the barriers to entry and growth. The series of changes that were introduced in industrial policy in the early 1990s were aimed at improving the domestic competitiveness of Indian industry, whereas the changes in foreign trade policy were aimed at improving the international competitiveness of the Indian industry, subject, of course, to the degree of protection offered by tariffs, which have been steadily brought down. Many areas which were reserved for the public sector were thrown open to the private sector, and the private sector has now a larger space in which to operate. It does not take away the role of the government. The government still has a role to play in terms of providing the larger policy direction It has a larger role to play in terms of the provision of public goods and services. And it has also to play the role of a regulator to ensure that the competitive system exists in the economy. And that is why, while the role of the private sector has expanded, the role of the public sector has been modified. And that is why the cryptic statement, more market does not mean less government, but different government. Therefore, if you look back, there were three major breaks from the earlier policy. One was to dismantle the large number of controls and permits which are required in the economy. Second, it redefined the role of the state. And third, it allowed India to integrate with the rest of the world and give up the old import substitution policy. In essence, the achievement of India in the post-reform period has been very impressive. In fact, if you look at it, in the more recent period, between 2005-06 and 2007-08, India's average rate of growth was in excess of 9%. In 2008-09, as a consequence of the international financial crisis, it came down to 6.7, but in the next 2 years, it again picked up and it was about 8.5%. Therefore, if you look at a period of 5 years, we have shown that India has the capability and the potential to grow at a rate of 8 to 9% per annum. Of course, we are also concerned with the fact that post 2011-12, the growth rate has been coming down. And more recently, we have the phenomenon of the COVID acting upon the economy. Now, there are many reasons why the Indian economy started slowing down after 2011-12. I do not think I have the time this evening to go into great details about it. But it does happen in most economies that when an economy has expanded in a strong way for a period of 5 years or 6 years, there is always some degree of decline. But I think the decline that we have seen is much more than that, and there are many reasons for it. Therefore, when we talk about the economic impact of COVID-19, it has to be seen that it came against the background of an economy that was already sliding. It came on top of it. But there is one important thing about the economic crisis that we are facing today. Not only we in India are facing, but many other countries in the world are facing. This economic crisis is very different from all the other economic crises that we have seen, is because that in recent memory, we have not had an economic crisis which is triggered by a non-economic factor, a pandemic in this case. The earlier crisis, whether it is 2008-09 or anything else, 1991-92, they were all triggered by economic factors. But what really has happened now is the impact due to a phenomenon which is not really economic in character. But then its impact is there on the economy, not only because of the virus, but also because of the actions that we have to take in order to curb the spread of that virus. The lockdown, for example, which has been seen to be essential in order to achieve that purpose of curtailing the spread, has had serious effect on the economy. It has brought the economy to a grinding halt for several months. Looking very briefly, it is very clear that the impact of the COVID-19 on the economy, like India, has been through 4 channels. One is the external demand. The second is the domestic demand. Third is the supply bottlenecks. And fourth is the disturbances or turbulence in the financial market. Very quickly, let me say that the impact on the external demand essentially means that India's exports are dependent upon how the rest of the world behaves. If the rest of the world is affected, then obviously they don't have the need for our imports, and therefore our exports to those countries come down. According to IMF and many others, as far as the developed countries are concerned, one is projecting a decline in the growth rate of these countries by 8% in 2020-21. So this is going to affect this. It is going to affect not only our export of goods, but also services. The only redeeming factor is a fall in the oil price, but that also has a bad side effect because of the fact that many of the remittances come from people who are employed in those countries, and that may get affected in a way. Domestic demand very quickly has 3 elements. One is the private consumption expenditure. The second is the public consumption expenditure. And the third is investment. Many people talk about the fall in the private consumption expenditure. But private consumption expenditure is not an autonomous variable. It is a function of income. If the income goes down, then obviously private consumption expenditure will also go down. But public consumption expenditure is autonomous. In fact, public consumption expenditure will go up during the current year 2021 because of the health-related expenditures, because of other expenditures which are being incurred in order to take care of the people who have been affected by coronavirus, like the migrant labor, and so on. So public consumption expenditure will be high. And thirdly, on the component investment, it is not very clear at this particular point whether both private investment and public investment will increase given this situation. There was a good corporate tax amendment that was made last year in order to stimulate the flow of investment into manufacturing. But I doubt very much whether that impact will happen in 2021. Therefore, both private investment and public investment may not pick up to the extent that one desires. Then the question that really arises is, what are the remedies or what are the measures that can be taken? Before that, let me make one point. People have been making forecasts about what the rate of growth of the economy will be post-COVID-19. As you must have read, that IIMA, for example, originally, I think it was in April or May, projected a rate of growth of 3% for India in 2021. But now, as you know, they have projected a negative growth rate of somewhere around 3%, a turnaround of almost 6%. World Bank has also similar estimates. There are some others who think that India's growth rate may be minus 5% during 2021. My own feeling is that perhaps that the growth rate may not be that negative. I personally think that the A small positive growth rate cannot be ruled out, even though no one can be certain about what will happen, because it depends upon two factors. One, how long will the lockdown continue? And two, how quickly the recovery will happen. Therefore, one has to be very cautious in making a forecast for what is going to happen in 2021. But the lockdown is lifted very soon. We do have 3 quarters of the year during which some compensation for the decline in the first quarter can happen. Therefore, I'm not as strong in the view that the growth rate will be negative 3% or 4%. It could be that there is no growth or maybe even a positive growth. But this is a guess, and this is as good a guess as anybody else's. Now, coming to the economic impact and talking about what needs to be done, what are the policy instruments that are available in order to take care of the problem? The two major policy instruments, one is monetary policy and the other is the fiscal policy. Monetary policy has been quite active post-COVID-19. In fact, monetary policy has been acting to bring down the rate of interest even before the advent of COVID-19. But that has accelerated since then. You must have all read the various measures. Very quickly, I will say, all the measures that have been taken by the monetary authorities fall into 3 categories. One is to bring down or to make changes in the policy rate. 2, to augment liquidity in the system. And 3rd, to bring about or to make some regulatory changes which will help the banks to provide more credit. As you know, the policy rate has been brought down. The repo rate, as they call it, has been brought down to 4% from 5.15% by the end, which was the level at which it was at the end of March. Therefore, there is a significant reduction in the policy rate. Therefore, one has to ask the question, to which I shall come a little later, whether the reduction in the policy rate will deliver the goods or not. The second is to augment liquidity, to make available more funds to banks, NBFCs, and others. As you know, that open market operations have been conducted by RBI to expand liquidity. They have also been doing long-term repo operations. They reduced the cash reserve ratio from 4% to 3%. That one act alone will give additional liquidity to the banking system to the extent of 1 lakh crore. So, without going into the detail, I must say, there are several measures that have been taken in order to augment the liquidity of the banking system so that it can lend. You may, if you wish, call it the quantitative easing by the Reserve Bank of India. And the third set of measures that have been taken are some regulatory changes which will enable the banks to lend better. Sometimes this is also called regulatory forbearance. The regulatory changes, for example, include such things as the moratorium that has been declared. First, the moratorium was declared to the extent of 3 months in relation to the payments that are due on long-term lending. This moratorium was further extended by another 3 months. There are many other things which I will not go into. So to take all of them together, the question that you might want to ask is really whether all these measures are in the right direction, and 2, whether they're adequate to meet the problem. in a sense, they are in the right direction, because in a situation in which the economy is placed, obviously, you have to kickstart the economy. And to kickstart the economy, you have to provide liquidity and you have to provide lending on easier terms. But the question always is that whether that will do the trick. For example, whether the lowering of the rate of interest will be such as to really stimulate the economy. Perhaps to some extent. Certainly, lowering the rate of interest will be lowering the cost to the entrepreneurs, and therefore it will have an effect. Therefore, and liquidity augmenting is also the right thing to do, because the banks will have adequate funds at their disposal so that they can lend to the others. Therefore, the question really is that whether augmenting the liquidity and lowering the policy rate and reducing the rate of interest will accomplish the kind of measures that will be adequate to stimulate the economy. While these are measures which have to be taken, we have also to be conscious of the fact that it is not always possible for these steps alone to stimulate the economy. There's an old saying in central banking which says that the monetary system has got efficient brakes, but the accelerator is uncertain. Because of the fact that when you raise the rate of interest strongly, then it does affect the actions of the people. But when you lower the rate or augment the liquidity, it is only facilitating, but whether it will actually lead to the expansion which we desire it remains to be seen. There are other factors that also come into play. Nevertheless, I would say that the RBI has been proactive and the measures taken have been in the right direction. But how far they will actually help in stimulating the economy remains to be seen. But these are measures that really deserve to be taken. The next and the more important policy instrument is the fiscal policy. As you know, people, analysts, put a lot of emphasis on increasing government expenditure. It is that whenever there is weakening of the demand, the best way to stimulate the economy is for the government to increase the public expenditure. In fact, the original Keynesian analysis did not make any distinction between one expenditure and another expenditure. And that is how, you may all have heard of it, the expression also came into vogue, digging holes and filling them up. So long as there is government expenditure, it will stimulate a demand. But now, of course, we do make a distinction between one type of expenditure and another type of expenditure. Unfortunately, the government was already in a difficult fiscal situation, even at the beginning of the current fiscal year. Even as the finance minister presented the budget by the end in February, it was a difficult situation because the fiscal deficit had to be pegged at a higher level. The fiscal deficit was pegged at 3.5%. But even then, many analysts felt that looking at the revenue projections and the expenditure projections, perhaps the fiscal deficit would be exceeded and there will be difficulty in holding it at 3.5% of GDP. The Therefore, the real issue is how far can we go in increasing the fiscal deficit? You may recall that the revenue projections for 2021 were made by the finance minister on the assumption that the overall income growth in nominal terms will be 10%. I already told you the kind of projections that are going on now regarding the real growth in the economy. Therefore, the nominal growth of the economy will not exceed more than 4 to 5%. Therefore, it is really half of what the nominal income was assumed to be when the budget was presented. Therefore, there is going to be a steep decline in the revenue projections, in the revenue collections of the government. Therefore, this itself will bring about an increase in the fiscal deficit of the government. I agree. I am of the view that perhaps that given some additional expenditures which we have to make, given the fall in the revenue projections, the overall fiscal deficit of the sector will go up by about 5.5%, go up to 5.5%. And then you have to add some stimulation expenditures, which now come to about 1.5%. Therefore, as against 3.5% of the GDP, as originally planned in the budget, perhaps the fiscal deficit of the government of India will be about 7% of the GDP. The state governments are allowed to incur a fiscal deficit up to 3% of the GDP. And a relaxation has been made that they can go up by another 2%, which they will all do. Because as you know, that there are three kinds of expenditures that the government will have to incur now. One, healthcare expenditures, which will include extension of hospital facilities, acquiring accessories like ventilators, masks, and many other things. Then, taking care of the people who have been thrown out of employment, like the migrant labor. And third, some stimulation expenditure. I do not think I have the time to go into great detail the various measures that have been announced by the government in order to bring about, in order to act as a stimulant to the economy. But many of them are not budgetary in nature. Therefore, what you really have is a situation where the fiscal deficit of the center and the states will now be 12% of the GDP. Those of you who have looked at the World Economic Outlook of the IMF, which was recently put out, they have put the fiscal deficit of the government of India, of the fiscal deficit of India at 12.1% of the GDP. And China's fiscal deficit is also put at 12.1% of the GDP. There is only one other country in the world which has a fiscal deficit which is higher than 12.1% of the GDP, and that is the United States. That country has a much higher level of fiscal deficit expected to be. But as you all know, that the budget procedure in the United States is a very complicated one. And the president does not always has his way. Therefore, one doesn't know ultimately what it will be. Therefore, we are facing a situation in which the fiscal deficit of the government of the government at the center and the states will be about 12% of the GDP. Let me say very clearly that in a situation like this, the need for a higher level of government expenditure cannot be disputed. The government has the role to play as a stimulant of the economy. But the whole question is, how high can you go as far as the fiscal deficit is concerned. As you all know, that the Fiscal Responsibility and the Budget Management Act specifies the desirable level of fiscal deficit of the center at 3% and that of the states at another 3%. Therefore, we are now talking about a fiscal deficit in excess of twice what was mandated in the various acts. And please remember, this is not the total of public borrowing. The public sector borrowing also includes the borrowing by the public sector enterprises. That is another 3% of the GDP. Now you can simply ask the question, how does one say that 12% of the GDP is untenable? The question arises, where from the contributions to the debt? I mean, fiscal deficit is really the borrowing of the government of India or the borrowing of the center or the states. Therefore, where and who will actually invest in the bonds floated by them? There are only three sources. One is really the, if you look at it, the financial savings of the household sector, the public sector savings, and the net inflow of resources from abroad. I have a feeling that even this 12% of GDP will require some amount of help from the Reserve Bank of India. Without it, it will not be possible for the government to raise the amount of debt that they are thinking in terms of. You must have heard a lot of people arguing that there is need for much larger level of expenditure. A much larger level of expenditure is possible only if the support from the Reserve Bank becomes even larger. The support from the Reserve Bank is what we call the monetization of debt. That is actually what it essentially means is the loan is picked up by the Reserve Bank of India and consequently there is an expansion in money supply. Some people may claim that in a very bad situation, what's wrong with monetization of debt? I have written one or two pieces of this subject where I've argued, yes, some amount of monetization of debt is inevitable, but it is wrong to argue as if there is unlimited amount of monetization of debt. What happens when there is a high degree of monetization of debt? Money supply increases. When output is not increasing, or when output is increasing only at a slow pace, it can only result in prices rising, if not in the current year, but in subsequent years. All of you may recall what happened in 2010, 11, and so and later on. The high level of fiscal deficit in 2008, 9, and 9, 10 of this government of India, which is 6% of the GDP at that time, resulted in a later, not in those years, but in subsequent years, in the money supply, the impact of the money supply on the prices. Therefore, let me not give the impression that fiscal expenditures have no role to play. Fiscal expenditures are needed, and they must be ready to expand the expenditures. And in fact, there is a reason for directing some of the expenditures, more of the expenditures into investment. And some amount of monetization of the debt is also inevitable. But we need to watch and we need to be cautious about the extent of monetization of the debt. As they usually say, wisdom lies in striking an appropriate balance. Let me finish by only saying a few other things, and that is the reforms which were initiated in 1990s had an important impact in increasing the potential growth of this country. It is not enough to come out of the impact of COVID-19. It is important to go back and achieve the kind of growth rate that we had earlier between 2005-06 and 2007-08. Only then we will be able to solve many of our problems. Growth is the answer to many of our socio-economic problems, whether it is reducing poverty or improving the standard of living of the vulnerable groups. It is growth that will facilitate the government to accumulate more revenue and incur the expenditures. But reforms are needed to achieve growth. In the early 1990s, the focus of the reform was in a broad way of removing the controls and creating a more competitive condition. Now what is required is to look at specific sectors of the economy and work on what is required to be done in agriculture, but more particularly agricultural marketing, in power sector, in telecom. All these are areas in which we need to move faster by introducing the appropriate set of reforms. Land reforms are needed. Labor reforms are also needed, but I have always a caveat on that. Labor reforms are easier to introduce when the economy is on the upswing rather than on the downstream. Therefore, we need to wait till the economy picks up and the employment picks up. Then we can think about labor reforms. But the reforms in all other areas are needed. And we should really focus on specific sectors of the economy in order to accelerate economic growth. So that is where we stand. COVID-19, as I mentioned earlier, came on an economy which was already sliding down. Our task is not only to come out of COVID-19, but also to ensure that the potential is achieved. Many people talk about India becoming a $5 trillion economy. We are a little above $2 trillion economy. We are a $2 trillion economy. In order to achieve the $5 trillion economy, we need to grow at 8 to 9% per annum for a period of 10 years. Period of not 5-10 years, period of 6 to 7 years in order to achieve that level of the economy. Even then, our per capita income will not be as will not make us come to the level of a developed country. In fact, if India has to achieve or get the per capita income of a developed country, India needs to grow at the rate of 8 to 9% per annum for 22 years. That is the kind of challenge that we have in this country. We have shown that we are capable of growing at the rate of 9% per annum for a period of 5 years. We should ensure that we can repeat that story. That is where our strength must lie. Thank you very much. From December 1990 onwards, which would bring about significant changes in the economy. First, of course, we had a real problem, as you all know. Our foreign exchange reserves had dropped to a level at which it was equivalent only to 3 weeks of imports. So in December 1990, we had really a very serious situation on our hand. That is why, if you look at the actions taken in the 1990s, they fall into two categories. One is stabilization, and the other is structural reform. First, we had to stabilize the economy. Then we had to introduce a structural reforms so that we can achieve a higher rate of growth. And we went to the International Monetary Fund in December 1990 and January 1991. I went there at that time to negotiate with them. We first, of course, negotiated certain lines of credit which are easy to obtain. But the negotiations had to be continued over a longer period in order to get a line of credit which is much longer. But the point really is, two or three things happened. We had to take some quick and important decisions. One was the decision to devalue the rupee. And, devaluation of the rupee is always looked at very favorably in this country. And particularly when the devaluation is of this magnitude. But you must have all read that how we did the devaluation in 1991. We did it in two stages. And when I announced it on the first day, there was a lot of turmoil in the market, where we are going. And normally, in the past, the decision to devalue is announced by the government. Here, I use the normal mechanism of changing the value of the rupee every morning to introduce a big change. You must have read about the fact that Mr. Narasimha Rao left some fee after the first decision after the first announcement was made. And he almost called Dr. Manmohan Singh to say, you stop the second one. And Dr. Manmohan Singh said that we have given the mandate to Dr. Rangarajan. I will try to contact him and do it. So he tried to call, and I was not available. And then finally called me that morning at 9:30 or something and said, what is the situation? I told him I have jumped. I had already announced the second one. And then Manmohan Singh went to the Narasimha Rao and said, it's all done. Then Narasimha Rao could not say anything later on. But the fact of the matter is, these are hard decisions. Look at the decision to send 40 tons of gold abroad in order to raise $400 million. Initially, we sent gold in normal aircrafts. But then later on, the normal carrier said, we can't take the risk. So we chartered a flight and put, I don't remember exactly, 25 tons or 30 tons of gold into it. And it was to be shipped, it was to be sent to London. It was a very traumatic moment to take such a decision. But please remember one thing. This decision was approved by the Chandrasekhar government. The only thing to be said to the credit of the new government was that the new government did not object to it, and we had to, we transferred this. But you can understand the kind of turmoil and the personal anxiety through which we have all gone at that particular point in time. I can tell you one other instance where it was a very difficult decision. You know that the value of the rupee was being determined by the Reserve Bank of India every day at 9 o'clock. I used to do it when I was the Deputy Governor of the Reserve Bank. But in February 1993, we took a decision, a bold decision, to move away from it and to let the rupee determined by the market. You do not know how many people at that time expressed the fear that the rupee value of the rupee will fall so steeply that we would have a very difficult situation. But we managed it, and I managed it in such a way that the value of the rupee did not fall too much. And as you may recall, some of you, that the value of the rupee was at 31.32 rupees to the dollar for almost 2 years. Of course, there are problems attached to it, but the fact of the matter is, it is that. But let me tell you one thing that people ask. What made the government or what made the policymakers to change their mind? If you look at the policymakers, all of them have been part of the same tradition in the past. Manmohan Singh or Narasimha Rao or myself were all there earlier also. What made us take this decision in 1991? I think it is the enormity of the crisis that we faced, which forced us to take this particular decision. That we move away from the kind of principles which were holding us back. Therefore, in a sense that it is the enormity and the bigness, this very seriousness of the problem that made us look different, made us look for some different option. But as you know, that Narasimha Rao always used to say, it is a matter of continuity. We were all, I used the word even earlier, the break. The break is the word that I would like to use. But Narasimha Rao never used the word break. He always said that we are continuing the same philosophy, even though we are making a break. That is because the old gods in the Congress were holding us back. And therefore, he could not clearly say that he's deviating from that particular path. The thing is, Manmohan Singh was a thought leader. He was responsible for the philosophy behind the change. We were all together with him at that time, and we were doing it. But the political support for it was given by Narasimha Rao. I can tell you that Narasimha Rao was not a reluctant reformer. Narasimha Rao was a reformer who believed in reforms very strongly. But the manner in which he articulated it was very different from the way in which Dr. Manmohan Singh or I articulated. Therefore, there were many other decisions, but those decisions were not a decision to be taken at one particular point in time alone. They were continuous in nature. But the decision to devalue, the decision to send gold, or the decision to make a break with the past and move on to a new exchange rate management, were all decisions which had to be taken under great stress and strain. Many people have asked me that whether I have enjoyed being governor of the Reserve Bank of India. My answer has always been, I am enjoying it in retrospect. Basically, I think whether it is self-reliant or make in India, all convey the same thing. But there is a problem with these words also. For example, make in India some people are asking the question, how is it different from the import substitution policy that we pursued before 1991? Now, if the idea is that everything that we need should be manufactured in India, then it's a wrong approach. If you're saying make in India and for the rest of the world, it has meaning in the sense that you make the country competitive enough for the goods and services to be produced so that they can be sold elsewhere in the world. Therefore, make in India should not be make in India for India. It should be make in India for India and abroad, and go away from a simple statement of making everything within the country. I think that would be a wrong approach. Self-reliant, in a sense, is good partly, but if we interpret the term self-reliant to say that everything that we need should be manufactured in the country, once again, it's a wrong interpretation. Self-reliant essentially means that in some areas where dependence is not desirable, we should manufacture. But we should not extend the idea to say that all we need should be made in the country. I think that would be a wrong approach to the problem, and that would be reversing the policy and the philosophy that we have been following from 1991. Globalization was essentially in goods and certain kinds of services. The developed countries were not anti-globalization. When globalization also included human beings, that is when the real problem started. When UK wanted to come out of the European Union and took the measures, it is essentially because that they found in London the Polish people coming and doing the work in the restaurant and so forth. Therefore, the world was moving towards a situation in which employment was becoming a major issue. And in that particular context, when globalization also meant that people also can move smoothly from one country to another country, then the objection started rising. After all, the European Union was based on the principle of the persons also moving from one country to another country. And that is where the real problem came as far as the European Union was concerned. Therefore, I say that the problem of employment is also being wrongly attributed to the movement of people from other countries. The problem of employment is also arising as a consequence of the technological changes that are happening now. The emergence of artificial intelligence has an impact on the economy and on employment very different from the changes in technology that happened in the 20th century or even in the early part of the 21st century. Since then, the dominance of artificial intelligence has resulted in a situation in which the redundancy of human beings has become a question mark. Therefore, in this context, when they find that their jobs are going away, they have started raising the issue. Take, for example, the United States, the same thing. Because the unemployment rate was rising, and at the same time they found people from India or people from China or more particularly people from Thailand and other countries coming to the United States and taking the jobs. And they attributed it to the fact that these people are willing to accept a wage level which is lower than what the Americans are willing to accept. And therefore they started looking at looking at ways by which to prevent the people from coming in. Therefore, the anti-globalization sentiment started not so much with goods as much with the employment of people in the country. Now that the growth rate is falling, they have become even more conscious of the fact that it is better to prevent the goods from other countries coming, and the goods should be produced locally. But after all, globalization was not imposed by anybody. Globalization was an evolution by itself. Globalization came as a consequence of the fact that globalization leads to the better division of labor, a better concentration of activities in areas in which they are best manufactured, and therefore the theory of international trade propounded that as a consequence of that, the total welfare of the world will increase. That is why globalization became a strong movement, so to say. Nobody from outside came and pushed it like that, and it could not happen that way. But now, because the production is falling, employment is falling, they are blaming globalization. But I also think that this may be a phase, and once production starts picking up and we find a solution to some of the technological changes that about which I talked about, perhaps there will be a return to globalization again. But at the same time, there is also this issue that many people seem to argue that globalization leads to the inequalities among countries increasing. I think there is no evidence to show this, but this is an argument that is always put forward. But the fact of the matter is, Indian economic growth has been on a much higher level after moving away from the import substitution policy and adopting a globalization policy. Post 1991, we have not had a year in which we have had an acute balance of payments problem. Before 1991, we were always going around the world, so to say, with a begging bowl in order to get resources. Post 1991, it has not happened. So globalization, as far as the developing countries are concerned, have been taken advantage or have been utilized by some of the countries. They have benefited, some others have not. Therefore, these are things that need to be looked into, but I believe that globalization will make a comeback, not immediately, but after some time. Well, the problem exists. I mean, I think the one point that I did not elaborate very much is about the decline in the growth rate after 2011-12. For example, the credit growth between 2004-5 and 2007-8 or something like that was almost 3 times. And then it doubled again. Therefore, the credit growth was enormous during that particular period. And once growth started declining, many of the projects which are deemed to be viable became unviable. And the non-performing assets began to make their appearance. Therefore, there is always a concern about too rapid a growth of a credit. As I mentioned in my talk earlier, availability of liquidity, increased availability of credit is required. But that does not necessarily mean that bankers should be so open and give the loans in a haphazard fashion. In my view, bankers should not be neither adventurous nor timid. They should avoid the extremes. They should certainly look at where the needs are and provide credit. Loans of today should not become NPAs of tomorrow. Therefore, it is important to recognize the quality of the lending and at the same time not be too restrictive. Perhaps sometimes giving the credit at the right time may save the company rather than allow it to decline. Therefore, there are instances in which the availability of credit at the right point in time has really saved the enterprises. Therefore, all that I would say is, yes, the circumstances demand that more credit should be made available. Banks should intervene and provide credit, but they cannot have a loan mailer. I mean, I think that is not the kind of thing that one is talking about. What one is talking about is the provision of credit where it is needed and where a broad judgment is taken about the need and the requirement. Therefore, the answer to the question is the banks cannot now say that liquidity is not available. The liquidity has been made available. Therefore, they should really be looking forward and provide the credit with caution. Credit with caution should be the motto. Consolidation, when it happens as a consequence of decisions taken by the different entities which feel mutual benefit. I am not very sure that whether that principle has been applied or not. Just to ask the strong banks to take the weak banks, yes, is not the right approach to consolidation. The best way to consolidation is to ensure whether the coming together of the institutions is going to benefit all the participants in that consolidation process. I can understand a bank which is strong in the north trying to merge with a bank which is strong in the south so that they have a good all India presence. This is something that banks, the consolidation process can achieve. Therefore, the whole point really is that even after consolidation, the basic issues will remain. Are they adequately capitalized? Are they efficient in terms of the provision of credit? What is the kind of risk aversion and risk appetite that they have? All those questions will arise even after consolidation. What should be the nature of the reforms now? There are areas in which the reforms are very badly needed. For example, the power sector. The power sector plays an important role in the economy. It is part of the infrastructure. Therefore, the viability of the power units is a very important thing. And therefore, but the power reforms have been talked about for a long time. And there is a reluctance on the part of the many governments to implement the power reforms because of some commitment that they have made to the constituency to which they belong, in the sense the larger people. So that is the kind of thing. And for example, the banking system you talked about, I think we really need to look at what needs to be done in terms of regulation, in terms of capital adequacy, and so on. These are, I mean, I must tell you one thing. The big bang reforms that we introduced in 1991 is not possible now. That stage is over. The basic principle of a competitive environment and all that has been accepted. Now, as I said, you can only look at structural reforms. For example, in agricultural marketing, why should not the farmer be able to sell his product directly to the consumer or to the retailer? This was the APMC Act was coming in the way. We had recommended earlier that the APMC Act be amended. Now, I think the process is going on now. Therefore, you need to look at every sector of the economy and see what are the factors that may be coming in the way of competitive structure being structure not being implemented. The basic principle of liberalization should occur. I think the allowing the private parties into coal mining is a good decision. I think it is. It has been talked about earlier, but since there is a Nationalization Act which says that all the coal mines belong to the government, we have to find some alternative solution. But the point really is that the way to do it is not some general principles which was required in 1991, but sector-wise understanding of the problems and producing the changes that are required